Hey folks, Daniela Cambone here for ITM Trading with a PSA for you today. If you see any slight pullback in gold prices or silver prices, this might be your cue to seize the moment and start your allocation of wealth into physical gold and physical silver. It's super easy to do by booking a Calendly appointment with us here at ITM Trading. The link is below in the video description. You pick the day, you pick the time that suits you best. And it basically is an education and strategy session centered around starting your journey by owning physical gold and physical silver. Do it today. You won't regret it. My guest today says that staying in cash is dangerous, accumulating government bonds is reckless, and rejecting the idea of gold is simply denying the reality of money. Please welcome to the show today Daniel Lacalle. He is a professor of global economics at the renowned university IE in Madrid, and he's the best-selling author of numerous books and articles that I have enjoyed reading throughout all these years. So I'm just thrilled to have you here today, Professor. Thank you for joining me on the Daniela Cambone Show.
Thank you so much, Daniela. It's a great pleasure. I'm really looking
Yes.
forward to it.
Yes. I mean, like I said, I've been reading your work for so many years. And I was like, where should we start today? Let's start with something nice and light and talk about the U.S. federal debt and where we're headed with it. It has soared to over 35 trillion in less than a year. The federal government has increased its debt by 1.9 trillion, and this occurred during years of record tax revenues and economic growth. So the question that I know you get posed is, how is this sustainable, right? And what kind of trajectory are we on? I'm going to hope that we can get to some sort of conclusion today. But for the audience that's new to you, Professor, what is the trajectory like? Is it sustainable?
The trajectory is certainly negative and not sustainable. If you look at the Treasury's own estimates, they expect that between 2024 and 2034, the national debt will increase by $16 trillion, even if there is no recession, record tax revenues, and strong employment figures.
Right.
So that shows you the level of unsustainability of the US debt. And numerous times, what you hear is that there is no problem, that the US can issue all the debt that it needs because it's always going to be the world's safest asset. Well, that is not true. No, we have a number of limits and a number of warning signs that are already evident. The first is the economic limit. We know by now that for every dollar of new debt in the United States, the GDP improvement is less than 50 cents. We also know that the expense of the budget in interest payments has ballooned to over $1 trillion, which is also a very significant limit because it means that basically very soon the US government is going to basically collect taxes to pay interests on debt, even if interests are low. The second is a fiscal limit, is that we have seen how increasing taxes does not improve the level of deficit. And we have also seen how those tax hikes have made it more difficult for small businesses and for families to make ends meet. And finally, there's the inflationary limit, is that after 4 years of record oil production, economic growth, job growth, etc., the accumulated inflation that citizens in the United States are suffering based on CPI figures is 20.4%. But it's even worse if you look at non-replaceable goods and services. It's about 50% in many cases in some of the items that we consume on a daily basis. So the fiscal, inflationary, and economic limits are already warning signs that it's not sustainable.
And therefore, if it's not sustainable, how will this play out? I bring up this quote that you said, and it rings so true. Those who ignore the accumulation of public debt tend to do so under the idea that nothing has happened yet. This is a reckless way of looking at the economy, a sort of we have not killed ourselves yet, let us accelerate mentality. Professor, I feel that is the mentality, especially for the fact that the talk of the debt has not appeared at all on the US electoral stage, right? We're
I,
just,
I
what, days away from an election now, and no one is talking about the debt.
No one is talking about the debt when, even, for example, in the economic program of the Republican Party, they're talking about maintaining the reserve status of the US dollar. Well, if the United States continues to increase debt in this way, which is not just massively increasing debt, but seeing a decline in the percentage of foreign ownership of that debt relative to net issuance, what it's going to do is actually put at risk the US dollar as a world reserve currency. Because everything looks like there's no problem until there is a problem. And the problem is that risk accumulates uh, very slowly, but it happens very fast. So the idea that nothing has happened yet, to start with, is false. We have already mentioned about the inflationary limit and the fiscal limit. We are already seeing how the government increases taxes and the receipts relative to expenditures are actually not improving. No, so all of those elements are pointing to a danger sign, and the fact that some people ignore that danger sign and consider that it's not a problem is predicated on the idea that the United States is going to continue to transfer its fiscal imbalances to foreign nations. But we are already seeing how central banks in China, in India, in Oman, and so many other countries, they're actually rebalancing and they're buying more gold and buying less treasuries. Even Japan is purchasing less treasuries than the net issuances. So all of those elements show that it's a warning, show the warning signs. Ignoring them is incredibly reckless because it can happen very, very fast. And by the way, it has happened to developed nations. It happened to the UK and the British pound. So the idea that it's not going to happen to the US is simply farcical.
So, few questions come to mind is that, well, the US obviously must be aware of the fact that it could happen here.
Hmm.
So, what playing cards do they have?
Well, there are a few, and they need to be implemented all at the same time. It's not just one. The number one is obviously curbing discretionary spending.
Mm,
Uh, no solution to the national debt can come from increasing expenditure. You need to administer, and knowing, like anyone that looks at the US finances knows, that mandatory spending is going to increase regardless. Managing discretionary spending is absolutely critical. So that's one thing, but it's not enough. Number two, you need to implement pro growth strategies. For the past decade, pro growth strategies have been basically abandoned by the administrations. You basically have sort of European style redistribution strategies, ignoring that what you need to do is to focus on strengthening the growth of the US economy, but not just the GDP growth by bloating government spending and bloating debt. That is relatively easy and certainly not a solution. But making small businesses thrive, making the middle class strengthen its purchasing power, helping more investment come to the nation, i.e., it has to be about thinking of large businesses not as a threat, but as a goal. We need more big companies. We need more wealthy people, not less. We need we need pro-growth strategies. So it has to be focused, instead of focusing on penalizing success and penalizing the large businesses. What it needs to do is help small businesses become large businesses and multinationals, and build a much stronger private sector economy.
Right. Well, that's so far from what is happening. As you know, Professor, the small business index, I was looking at the numbers today, it's at its lowest level, which it measures basically the sentiment of small businesses, lowest level since 1975, right?
Yeah,
So
I mean it's
one, yeah,
yeah. No, it's atrocious. I mean, think, but because we need to put it in context. No, we need to
right,
remember that in the past 4 years, the US government has implemented a very large fiscal stimulus package, Build Back Better, large government spending, huge deficit spending that is allegedly, yeah, supposed to be a tool to help the economy strengthen. And the economy has weakened in small businesses, in families. It has weakened in terms of domestic investment, and it's weakened in all the aspects that we're thinking in order to strengthen the private sector. Hmm?
so why not do the steps needed? Why are the politicians not enacting the landscape and the path that you've just laid out? Why destroy the middle class? Why destroy
Well,
small business?
it's it may sound to you like I'm using a conspiracy theory, but it's not. Hmm? You create dependent subclasses. The idea that interventionist governments are going to strengthen the middle class is simply ridiculous. It's ridiculous because you don't want the middle class. A middle class is combative, is a critic, is independent. Hmm?
Right.
Economic freedom does not go well with governments that want more dependent citizens. So the best way to create more dependent citizens is saying the following: is saying I'm going to tax the rich and I'm going to tax large companies, when in reality what you're doing is destroying the purchasing power of the salaries and the deposit savings of the middle class, and at the same time making it impossible for small businesses to become the large companies of the future. No? So ultimately, instead of being a policy that actually allegedly harms the wealthy, which, by the way, is not a good policy in any case, but it doesn't matter. It does not harm the wealthy, because the wealthy can actually at least defend themselves against inflation by investing, by moving abroad. The large businesses can go anywhere else to
Right.
deploy capital. That's relatively safe. The problem is that for if you what you really want to do is to have a nation that is completely under the government control, the best, unfortunately, way to do it is by destroying the middle class. And that sometimes is the hidden policy behind the so-called redistribution policies, because those are not redistribution policies from the wealthy to the poor. Those are redistribution policies from the middle class to government. And that is what creates a dependent nation.
It does not sound like a conspiracy theory to me, Professor. Um, basically the way you've laid it out. Unfortunately, I feel this is the path that we're on. Um, so that begs the question of what do the next 10 years look like? Because
Well,
one
yeah.
scenario, one scenario we didn't play out is what is the possibility the US would default on their debt?
Well, the US will not necessarily default on debt the way that we think, for example, of Argentina or Greece. No? That is not likely to be the case. What is very likely to be the case is that the de facto default, the implicit default of inflation, is going to be the way in which the government passes its fiscal imbalances to the citizens. Think about what we just mentioned. The percentage of net issuances of US debt owned by foreign investors has been relatively stable, growing a little bit in the past 2 decades. However, in the past 4 years in particular, the US debt has ballooned much faster. So all of that debt is now in the hands or in the balance sheet of the United States citizens and the private sector and the public sector of the United States. Fair enough. How do you default on that debt? Via inflation. You default on that debt, making the citizens of the United States poorer. The currency loses its purchasing power, and the obligations of the government in real terms are slightly diluted, while the savings and the real wages of the middle class and the poorest are actually weakened significantly.
Which brings up another quote of yours that's stuck with me. The government's destruction of the purchasing power of the currency is a policy, not a coincidence. So they want to destroy the dollar, Professor?
Well, they would hope, like every politician, that the dollar remains in use. But from the perspective of the government, however much they spend is not a problem. No, and they assume that ultimately what they don't get is, or a lot of politicians don't get, is the connection uh, between the demand for U.S. dollars and the demand for U.S. debt, which is one and the same. No. So a lot of politicians actually, the way that they look at it is that they can always pass further imbalances to the to citizens, and that inflation has nothing to do with them, but it's the opposite. No. So do they want to destroy the US dollar? Probably not. But what they want to certainly do is to promise things now and in the future in a currency that they will issue as much as they can, and then when it loses purchasing power, then they blame somebody else. The great thing for an interventionist politician about inflation is that people may blame stores and businesses because they see that those are the ones putting the price and not the one that destroys the purchasing power of the currency. No. So the government can go and say, I promise you trillions of dollars in entitlements. Will I pay for them? Yeah, but in which real term, in which value of the dollar will I do it? And
Exactly.
no one no one that has the monopoly of issuing the currency, and at the same time is by regulation and by law issuing a debt that is considered the lowest risk asset, is ever going to consider that that debt and that currency is going to be out of fashion. They always think that it's going to be something that will be demanded. That's how every empire in history has fallen, by believing that the currency is completely impossible to beat.
That's exactly it. And it raises a whole other question of, yes, there's talk of inflation. Yes, people feel the stress at the cash register. They know their milk went up. They know their eggs went up. But do most people realize it's the decline of their purchasing power?
Uh, very well. I would say that not everybody, but a rising percentage of people. For example, we have seen in Argentina how the election process sent
True.
people to
True.
the ballot box saying no more of this
Yes.
printing money. No. So people actually do blame governments. Governments that create inflation will always use the excuse of, oh, it's evil corporations, oh, it's OPEC, oh, it's the war, oh, etc. No, I mean, none of those things makes prices rise, consolidate, and rise again, and consolidate and rise again. And it's aggregate prices, not individual prices. So So ultimately, what's interesting about this is that even though the entire narrative around governments tells you that they are not to blame. In fact, citizens blame them for inflation. And we have seen it in the election processes in Europe. And we have also, and I think it's going to be a very, very significant driver of. Of the US elections. Because in the US elections, you get them saying, okay, how are you going to deal with rising prices? And if the trick is to say, oh, I'm going to put price controls. I'm going to put price controls, and
Right.
that will bring down prices. Well, if you believe in that, which obviously never works, you would the first thing that you would say is, why didn't you do it? Why didn't you do it in the first place? No, when you were in power. But most people see that concept of price controls and they say it doesn't make any sense. And it doesn't, obviously, because the government doesn't decide what is the price of goods and services. The government can lift prices up, but it cannot bring prices down. No. The only thing that can bring prices down is competition and and monetary stability and obviously technology.
So then shine some light, talk to us now regarding this entire narrative, how they can use it to usher in a central bank digital currency, which I'd like to add, Professor, I personally have noticed they've kind of put the brakes on the talk. Like I know the Bank of Canada now retracting, oh, we're not really in a rush for central bank digital currency. But before we were talking so much about central bank digital currencies, is it a coincidence that the rhetoric, the talk around it has softened? I would say in the
Yeah.
past year.
It's not a coincidence. Obviously, citizens are angry about inflation, even though the news tell them that inflation is declining. They know that inflation is accumulative, so that it's not like they are like those prices are falling. No, and they understand that there is a relationship. Even people that have no clue about monetary policy or economy, they know that it makes no sense to say that inflation is due to is due to the is due to evil corporations when they see that those allegedly evil corporations are the ones that are able to bring down prices when monetary aggregates come down. No. Uh, they know that the central bank is doing something that is negative for the purchasing power, and they also know that the central bank doesn't print money because they want to or because they're evil. No, they print money because the government is spending it and spending it massively. No, so the point there is, why have they decided to stop talking about central bank digital currencies? Because the confidence in the fiat currency and the currency issued by governments is declining. Is declining. That's why gold is soaring. That's why people are all the time talking about the European Central Bank or the Bank of Japan or the Bank of England, the U.S. Federal Reserve. What is going on? So even the people that don't follow, your news or your or different financial media, they know that something doesn't compute, and that if you give even more power to governments and central banks to control the currency, that is going to be detrimental to their purchasing power. So they have decided to postpone it, but that doesn't mean that they have decided to abandon it. And all central banks know that it's a bad idea, But that's why they want somebody else to implement it first. The Federal
Ah,
Reserve says, you go, European Central Bank, you go ahead, do it, huh? And see how it goes. And when it fails, maybe retract, maybe try to sell it in a different perspective. So everybody's sort of saying to the other central banks,
right.
be my guest and try it. No?
Well, no one's going to want to go first, Professor.
And no one wants to go first. That's a key point, what you just said.
I started the show by saying, your statement, owning cash is dangerous. how much of that is tied, to what we were just speaking of, the decline of the purchasing power? Or are you also concerned about the banking sector?
The banking sector is a second derivative of the monetary and fiscal problem we have mentioned. No, the banking sector tends to be uh, the sort of last alarm signal. And why? Because in the asset base of a bank, of a commercial bank, the allegedly safe asset is government debt. A lot of people say that banks went down because of the subprime crisis or because of this, but subprime was a relatively stable part of their asset base. It wasn't something that brings you down. What brings you down is when the allegedly lowest risk asset starts to decline and you lose the asset base, which is what happened with the regional banks. So what I am concerned, what the reason why I say that it's dangerous to hold cash is because when you say, people think that holding cash is safe, and it's not safe. You have somebody that is literally every day with there's a hand in your pocket, taking money out of your pocket. It is not safe. You need to invest it in order to protect yourself from inflation. So that is why I think it is dangerous. In the risk of commercial banks is equivalent to the increasing risk of the sovereignty in monetary terms of the government.
Denying gold is denying the reality of money.
Hmm.
What do you mean by
Oh,
that?
well, because fiat currencies, what we hold every day, the money that we consider, first, it's not money, it's credit. Okay, what we're holding in our hands, or what we have in our bank, is not money. Money is a reserve of value, a unit of measure, and a generalized mean of payment. In the world, more than 50% of the currencies issued by governments are not money. They're not a reserve of value. They're certainly not a unit of measure. And in numerous cases, it's not even a generalized mean of payment. You go to Venezuela, you walk down the street, and you see state currency on the floor, alongside garbage. No? So we need to understand that the closest thing to money that continues to exist in the system is gold. No, there may be in the future other possibilities that are reserve of value, unit of measure, and generalized mean of payment. But that certainly is far away from where, for example, Bitcoin is still. No, and gold has an undeniable track record. Anyone that doesn't like gold, and there are a few investors out there that think that it's worthless, and that's not, what they cannot deny is that when there has been any type of turbulence in the global economy, whether there were wars or whatever it is, that you use gold to exchange for goods and services. Other things, less less likely.
The other thing they can't deny, Professor, is that central bank buying of gold is at record numbers. I mean, I know China has stopped a little for now, but why are central banks hoarding gold? What do they know that we don't?
hmm Well, I think that what they know is that the fiscal reality of world reserve currencies, not just the dollar, but the euro, the yen, is so alarming that the only way in which governments and central banks are going to conduct themselves in the near future is by eroding the purchasing power of the currency, faster or slower, but eroding it. Therefore, when you look at the balance sheet of a central bank, the central bank has in the balance in its asset base the concept of reserves. But reserves, U.S. dollars, yen, euro, are treasuries, sovereign bonds. So when you see that the fiscal situation that we have mentioned of the world reserve countries is worsening, and at the same time the monetary policy is looking basically at dissolving the liabilities of the government as much as possible via the purchasing power of the currency, then that is not a reserve anymore. That becomes more of a risk than a reserve. So, what the central bank needs to have in the asset base is all of those uh, assets that are going to give stability, because that asset part is what is maintaining the purchasing power of their local currency, i.e., the liabilities of the central bank side. No? So if you, as a central bank, China, India, etc., hold more treasuries, more euro sovereign debt, etc., and those continue to decline in price, and the purchasing power of the euro and the dollar continues to decline, it ultimately hurts your local currency. The reason why they need to hold gold is because in the past 20 years, a lot of central banks started selling gold and buying more dollars because they saw that the US dollar, US treasuries were a safer, more stable, and actually an asset that would appreciate over time, whilst they thought that gold would not give that function. Okay, and what they found out is the opposite, is that
Mm.
debt can be a very dangerous asset because it doesn't appreciate when the government's objective is to dilute its own financial commitments.
So then bringing it down to the investor level, professor, what do you say when you hear, well, I'd love to own gold, but right now it's simply too expensive?
Hmm. What I say to people when they say that is, first, is that you're not looking at gold relative to money supply. You're looking at gold in absolute terms. You're looking at the price of gold. You say, oh, it's 2,600, 2,700, whatever it is at the moment. And they say, well, that's too high. It needs to come down. Well, that's like basically saying that the S&P 500 needs to come down. But if you're not looking at it relative to money supply and relative to, most important of them all, not just of debt that has been issued that we are talking about, that we have been talking about, but the non financed commitments, i.e., the debt that has already been committed but not issued yet. So, all of those unfunded liabilities of the government. When you look at the unfunded liabilities of the government, plus the increase in money supply generated by this
Right.
fiscal imbalances of today, those two things tell you that gold relative to money supply and relative to unfunded liabilities is actually not expensive, but actually basically just starting to discount that enormous challenge.
It's really quite interesting once you start connecting the dots, that everything just really starts making sense. I guess just to bring it home here, um, it's interesting to have people who deny the rise of the BRICS, who deny gold, or who simply say, well, the US will remain the reserve currency, because what other choices do countries have, even if there are so many bilateral trade agreements happening already? But the pushback I always get is, well, they always have to come back to the dollar
Mm-hmm.
because there is no other alternative to the dollar.
Mm-hmm.
What do you want those people to know?
Well, what they're saying is a plausible idea, but that doesn't mean that it's going to happen. The worst word out of everything that you just said is the word always. Hmm? And it's come
Right.
and I come back to the point that we mentioned before, is that you say they always will have to return to the US dollar. Oh, really? What do you think that the British government and the Bank of England thought with the British pound? What do you think that the Roman Empire thought with the sesterce? What do you think that the French government in the French Revolution thought with the assignats? Yeah, the concept of always is an absolute lunacy, because It comes from the idea that there's an economic agent, the United States government, whose ability to uh, increase its debt is unlimited. And I mentioned before economic, fiscal, inflationary limits. The other thing is that obviously, right now, a lot of people say, well, there's no alternative right now. Maybe there is no alternative. That doesn't mean that there will be. Furthermore, that doesn't mean that what you consider are the alternatives would be the alternative. It doesn't have to be a state issued currency. It doesn't even have to be one. No, the idea that it has to, that the yuan or the euro has to dethrone the US dollar. No. So all these things point to the risks that are building. Hmm? Obviously, in order to have a world reserve fiat currency, you need to have independent institutions, a completely open banking system, and freedom of capital. So there, I understand a lot of people will say, well, that's not going to happen with the yuan and the Russian ruble. Fair enough. You're absolutely right. That doesn't mean that it cannot happen. Huh? That it cannot happen. It can happen. If they, you can. Those are current limit burdens that don't necessarily stay forever. By the way, those are burdens that did not exist. That existed in the United States when there were intervention capital controls and an intervened capital system. The US has not had always the world reserve currency. Not
Exactly.
I mean, in history terms, it's an anecdote. The years in which the US dollar has been the world reserve currency. So saying the word always is so imprudent, it's almost laughable. So, so the alternative doesn't need to be the euro or the yuan or the yen or any other fiat currency. The alternative can be, we've just mentioned gold, we've mentioned there could be independent currencies. We could see in the near future technology giants issuing their own currency. What would limit their ability to do that? No? And all of those things point to the fact that the United States cannot just continue to issue all the debt and currency that it wants. Because on the one hand, there are already people that are saying, well, my central bank doesn't want more of your dollars. We are not selling the ones that we own, but we want more gold. India, China. Well, that is already saying that there are alternatives, no? Ultimately, when people talk about a world reserve currency, what are we talking about? We're talking about in what currency do you want the assets of the central bank to be in? That's what we're talking about. Okay, if the US government sabotages itself by increasing debt constantly well above the global demand of US dollars, it will itself destroy the world reserve currency status, as the British government and bank and central bank did, by the way.
It's interesting because the facts and truth always just lie in history, Professor. As you're saying that, I just came back from an incredible shoot in Umbria, in Italy, where the Etruscans ruled for 600 years, never thinking they would be taken over by the Roman Empire. And to your point, the Romans never thought they would fail.
Yeah,
But we don't learn from history, do we,
we,
Professor? So
we never do. We never do. We actually always believe the most dangerous sentence in the economy. This time is different.
this
This
time is
time is
different.
different.
Well,
Yeah,
so bringing it home, because I always want to give the folks watching just some
yeah.
tools, because they watch these interviews and then they're like, well, what should we be doing then, right? If we obviously can't control the narrative. How can we protect ourselves?
But you need to invest. And a lot of people say, well, I cannot invest because I don't have enough money. Fair enough. But you don't need to invest a lot of money In today's financial world, you can invest small amounts of money, and instead of having your money in deposits in the bank, have it invested. Have it invested, and depending on your ability to uh, absorb volatility, have it invested in equities that are going to give you that return of your money, discounting that destruction of the purchasing power of the currency. Have it invested in gold, have a portfolio, build a portfolio gradually, like all of us did. No, I started investing when inflation was 13.5%. No, in my country. So it wasn't easy. But what I'm trying to say is that any of the people that are watching us today should think of the following. You think that investing is risky. What is really risky is to hold cash. That is what's risky. There's no such thing as the decision not to invest. When you are holding cash, you are investing against the destruction of the purchasing power of the
Mm.
currency that we have just mentioned. So you have two certainties in life. Two. Number one, the government is going to try to dissolve its future commitments by issuing more currency and therefore paying those commitments in a lower valued currency. Number two, they're going to increase taxes. So you need to think from the fiscal and from the monetary side. And therefore, you need to invest in hard assets. Real estate is something that is worth investing in. Gold is something that is worth investing in. Equities are worth investing in. Remember, the reason why the S&P 500 is at all-time highs, despite all the challenges that we're mentioning, is not necessarily because of earnings and the profits of the companies involved, which it is to a certain extent. But the most important driver is precisely that: is the amount of money in the system. Therefore, don't think of corrections as a risk. Think of corrections as opportunities. And and that's the way to protect yourselves. In essence, what I would say to people is, in your own ability, what you need to do is exactly what the billionaires do. Hmm? Hmm? Do you think that billionaires are holding cash in a giant warehouse like Uncle Scrooge? No. What are they doing? They're investing, and they're taking those investments to real assets and to equities. No, do the same in your own ability. And obviously, you will say, "Oh, I don't have the money that they have." Absolutely, neither did they when they started.
Professor, I'm so glad we made this happen today. I thoroughly enjoyed this discussion, and we will see you soon.
I'm glad. I thoroughly enjoyed it as well. Thank you very much for the opportunity.
Professor Lacalle. Read his books, they're incredible. And thank you all for watching. Please remember to subscribe to the channel and to danielacambone.com so you can stay on top of all this great content. That's it for me. We'll see you soon.